Welcome back to Morning Trade Live. It's time now for the big picture. So let's welcome in Liz Ann Sonders, Chief Investment Strategist at Schwab Centre for Financial Research. Very good morning to you, Liz Ann. So we've got a nice rally underway this morning. Thank you, Micron. Thank you, CPI report. Can it last?
Well, I think we're going to see fits and starts. I think there is still that buy the dip mentality that kicks in, especially after you've had a bit of a pullback. As far as the CPI is concerned, and I say this somewhat literally, it's sort of unbelievable in the sense that there was no data collection the entire month of October and 12 days into November. So a much higher share of the components were estimated. We didn't get month over month readings. So I think to get what might be perceived as cleaner data, if not clean, we're going to have to wait until at least the December release, which of course doesn't happen until January. But you did see a little bit of a pickup in terms of percentage probability that the Fed can cut again in January. That said, that can change. That changes almost on a daily basis.
Oh, well, that's right. And obviously, we've got the jobs picture to keep an eye on as well. We had initial jobless claims coming in pretty much in line with expectations. Obviously, we're seeing a bit more of a risk-on type of sentiment today, but we have been seeing the markets, Liz Ann, obviously responding with a degree of rotation, particularly away from some of the high-flying AI names into other sort of more defensive, value-orientated type parts and corners of the market. Do you believe that this can continue?
I do, but probably not in a linear fashion. I think you'll continue to get days like today, which, in the case of today, it's not tech that's leading. It's actually consumer discretionary. And that may be based on the fact that we had a benign CPI report. Again, we'll have to see whether that lasts. But I think the general sense of a rotation where there's opportunities to present themselves outside of just a very small handful of stocks, I think that will be a characteristic of 2026. And it's already kicking in. Over the past 6 months, only 18% of the constituents within the S&P 500 have outperformed the index itself. But over the past month, that's up to 63%. You've seen now in the past month, or if you go back to the end of October, equal weight outperforming cap-weighted S&P 500. You're seeing Russell 2000 do well. Russell 2000 has a better improvement in its breadth over the last several weeks than either the NASDAQ or the S&P 500. So I think in general that has legs, but again, I wouldn't expect it persistently week after week, month after month.
You talked about fits and starts. I mean, that couldn't be more real, and the case for the Russell 2000. I mean, as far as the divergence that we're seeing between some of the small caps and, the NASDAQ breadth, just talk us through the case for next year. I mean, the case for small caps has been, getting a lot of tailwinds from obviously the onshoring, the CapEx, the rates coming down, not to mention the big, beautiful bill as well. That seems to be what some of my guests are telling me. But is it that easy? What are you seeing out there as far as the story moving into 2026?
Well, within the Russell 2000, which of course is a large index of stocks, so I'd say in general, I would caution investors against taking a monolithic approach, especially in a market environment like this, including looking at an index like the Russell 2000 in any kind of monolithic way. What has been interesting is since the launch point of the rally off the early April post-Liberation Day lows, it has been the non-profitable stocks that have really powered the Russell higher. And we've been saying for quite some time now, I think you want to fade that lower quality theme within the Russell 2000 and lean into the profitable companies. And that is also what has started to shift in the last month. You're seeing a narrowing in that extreme divergence, what has been in favor of non-profitable, little bit more of a shift now toward profitable from a factor perspective. And this is applicable up and down the entire cap spectrum. Value-oriented factors are performing well. That's distinct from saying value indexes will consistently perform well. But I think you want to screen when if you're a screener for stock ideas. I think you want to look at some of those value-oriented factors without giving up the growth side. So I'd say from a factor perspective, you almost want to have it look somewhat GARPy, growth at a reasonable price, to use an acronym from, a couple decades ago.
Okay, so don't be monolithic on the Russell 2000. I mean, certainly something that the market has not been monolithic about is technology. There certainly has been this rethink more lately, about some of these valuations, particularly off the back of stories around tapping debt markets to fuel what they're doing here as far as the build out, some of the delays with data centers. But then you get a beat like Micron, which then reinforces the fact that the data centers are really sucking the oxygen as far as the demand is concerned. We're talking about a memory AI supercycle, so far as the analysts are talking about. I was just speaking to my last guest, Victor Schwetz, about whether he sees an AI bubble. He doesn't see it bursting anytime soon, certainly not in 2026. But what is your modelling telling you? I mean, what are you seeing out there as far as the technology story moving into next year, Liz Ann?
To try to put comparative years on this, it certainly is possible that we're more in the 1997 period relative to, say, the late 1999 period. And the comments that I've made a couple times already in this conversation around fits and starts, I think it applies to a beat like Micron, where you get an outsized earnings result or a upward guidance at a single name level, and that really feeds optimism back into the general space. But there's also a much bigger punishment factor now for misses. And I think that has to do with the concerns about circularity and financing. The fact that this boom so far, let's not maybe yet call it a bubble, the boom so far has been financed out of cash flows. But in terms of the cohort of the Mag 7, 6 quarters ago, free cash flow growth was running at more than 50% year over year. The last 2 quarters, that's actually been in slight negative territory, helping to explain why there's more debt financing. And I think there could be time bombs from a debt financing perspective, but not in the aggregate. So I think that's the nature of the beast we're in right now. But the broadening out is also reinforced by this notion that maybe there's a shift in attention away from just the picks and shovels and the hyperscalers, beyond just data center and the energy powers needed for that, into what does this mean for the broader economy? How are the adopters bringing AI into the mix? Can we put meat on the bones yet in terms of impact on profit margins, impact on productivity statistics? So I think that will characterize 2026 in terms of AI, maybe a little bit more than the narrow focus that has existed up until recently.
Right. I like the analogy, the time bombs. Everyone's just listening out for the ticks and listening to the cadence, getting faster to see just when it goes off. Liz Ann, really appreciate it. Thank you so much for your time today. Happy holidays to you and your family if I don't speak to you again. Liz Ann Sonders, Chief Investment Strategist at Schwab Center for Financial Research.